We are just around the corner from the holidays and it's kind of the season of giving. So I wanted to bring up a couple ways that we can give more money to causes, charities specifically, that might be important to you, and how you can give more money to them using the investment portfolio you already have. So the first option is a way to do it through your taxable or maybe brokerage account. This is an easy way for you to give anywhere from 15 to 23.8% more money than if you wrote them a check. And what I mean by that is you could potentially give the charity, if they'll accept it, appreciated securities. So if you have any stocks, mutual funds, ETFs that have gone up in value, if you were to sell those and they were sold at a profit and then give the cash to charity, you would pay taxes likely at a capital gains rate of anywhere from 15 to 23.8%. Now, that is still a good outcome. If you made money on an investment and you pay a little bit of capital gains tax and the net investment income tax, if you are subject to it, then that's still a pretty good outcome and the charity gets a bunch of money. So I'd say that's a good thing. But there is a way that you could get around that and it would help you trim your tax bill. So it helps the charity get more money and it helps you trim your tax bill in the future and potentially today based on how your tax return shakes out. So you could take your shares of a mutual fund or an ETF, for example. Let's say you bought it for $100 2 years ago. Today, that hypothetical ETF or mutual fund is worth $120. Okay. So there's a $20 gain that's embedded in that asset that you haven't sold yet. So you could say to the charity, hey, I'm not going to give you a check, but instead I want to give you my share of appreciated XYZ ETF. Okay. So you'd collect some information from them to know where to send the share of the ETF, get their brokerage account number, the institution, that kind of thing. And then you could send it off to them. So the charity, if they want, they can sell it tax free. So now they have $120 and you get to put that you gave a $120 donation on your tax return. So you got an instant boost in the amount of money that you can give to charity, because if you had sold that $120 appreciated ETF, you'd have to pay capital gains taxes anywhere from 15 to 23.8% on that gain of $20. So bare minimum, that's another $3 that you got to give to that charity that you wouldn't have if you had sold that ETF at first and then given them the net proceeds after you pay the capital gain tax. Okay. So this is an easy way to just get more money into the hands of the causes and endeavors that you care about and help you trim your tax bill. So that will also help you itemize potentially more deductions. With the standard deduction that we have these days, it can be difficult to come up with enough charitable giving to justify utilizing itemized deductions instead of the really robust standard deduction that we have. But depending on how things change with the election, it's possible that itemized deductions might become fashionable again. And there's not to say that people don't enjoy itemized deductions today. There's still plenty of people who, for one reason or another, that works out better for them than the standard deduction. But this is a great way, giving money, giving appreciated securities to a charity to help you today through a deduction that you can enjoy in your tax return. It helps the charity get more money. And the sneaky benefit to this, which is probably my favorite part, is that it helps you reset your cost basis. So let's say that you had $120 that you were going to write a check for. You can use that $120 to now buy the share of the mutual fund or ETF that you just gave them. And now you've reset your cost basis from $100 with an embedded gain of $20 to $120. So it helps you march your cost basis higher so that when you do sell it in the future, you have a smaller gain. So you can use the cash that you were going to give them to buy right back into the fund that you just gave the charity, and it helps reset your cost basis. The second way that you can potentially give more money to charity is through a qualified charitable distribution. So this is for folks who are already retired and likely taking what are called required minimum distributions. So the IRS is telling them, hey, you have to take so much money out of your pre-tax retirement accounts every year so that we can tax it. This qualified charitable distribution strategy involves you writing a check directly from your retirement account to your charity of choice. Okay. It has to be a 501c3, and there are some other technicalities. You can only do up to 105,000, but any dollars that are sent directly from your IRA to the charity are not taxed. Now, this is a tremendous tax saving opportunity for you, because if it's income that you don't need, let's say you were going to support the charity anyway, why not give them a boost? This strategy is even more powerful because we are actually talking about the difference between paying taxes at ordinary income rates, which are higher traditionally than capital gains tax rates. You could potentially be saving 22, 24, or more percent based on the difference between you taking RMD that was unnecessary if you don't really need the income, and the charity getting a check for the full pre-tax amount that you were going to give them. So this is a great way for you to save money in taxes and put more money into the hands of the causes that you care most about. And there are just two ideas to help you keep more of what's yours, or give it to the things, people, places that you care about, rather than paying taxes unnecessarily. So just being smart, playing the game as the rules are written. I would encourage you, as always, to speak with your tax advisor, but I would love to walk you through, how this might look for you.